Let me tell you about two people. Person A starts investing at 22, $20 a week, puts it into an index fund and completely forgets about it. No side hustle, no business, no special skills, just $20 a week. Person B reads every finance book, watches every YouTube video, understands compound interest better than most economics teachers, and genuinely believes they're going to be rich because of it. They start at 30, they invest a little more, they do everything right. By 55, person A has nearly 4 times the wealth of person B. Now, here's where it gets interesting. That gap didn't happen because of compound interest, at least not in the way you think. If you've spent any time in the personal finance world, you've heard the compound interest speech. It's basically the gospel. Start early, let your money grow, time in the market, blah, blah, blah. And look, compound interest is real. It works. But here's what nobody tells you. Compound interest is the reward. It's not the strategy. And if you've been treating it like a strategy, you've been waiting for a bus that only shows up after you've already walked most of the way home. What actually builds wealth early, especially in your 20s and early 30s, is something completely different, something more psychological than mathematical. And by the end of this video, you're going to look at every piece of financial advice you've ever received in a completely new way. Stay with me, because this is going to get interesting. Here's the thing about compound interest. It's the most seductive idea in all of personal finance. You've probably seen the chart. You know the one, the hockey stick, where your money just sort of sits there doing nothing for 20 years and then suddenly explodes upward like it's been waiting for the right moment to prove everyone wrong. It's a beautiful chart. It's also kind of a trap, not because it's wrong, the math is completely correct, but because of what that chart does to your brain. When most people first discover compound interest, usually sometime in high school or early college, something clicks. They feel like they've been let in on a secret, like they found the cheat code. And the message they walk away with sounds something like this. Just start investing, be patient, and time will do the work for you. And then they open a brokerage account, put in whatever they can spare, and then they wait. They wait while their 20s pass. They wait while they stay in a job that underpays them because at least it's stable. They wait while they avoid negotiating their salary because that feels uncomfortable. They wait while they say yes to every social expense because YOLO, compound interest, will fix it later. They wait while they skip the uncomfortable conversations about money, about value, about what they're actually worth, because the chart told them time would handle it. This is what I call the compound interest sedative. It's a real psychological phenomenon, even if nobody's named it that before. The idea is so comforting, the idea that math will save you, that patience is the entire strategy, that it actually becomes an excuse for financial passivity during the exact years when being financially aggressive would change your entire trajectory. And here's the proof. Ask yourself this. If compound interest was the primary driver of early wealth, why is it that the people who build real wealth in their 20s and 30s almost never look like the person in the textbook example? They don't just invest steadily and wait. They're doing something else, something messier, something that involves decisions and behavior and psychology, not just time and percentages. So what is it? What actually builds wealth early? Let's start with a number. The average person in their mid earns somewhere between $30,000 and $50,000 a year, depending on where they live and what they do. Let's call it $40,000. After taxes, you're probably taking home somewhere around $32,000 or so. That's about $2,700 a month. Now let's say you're pretty disciplined. You save 15% of your income, which financial advisors will tell you is excellent. That's $405 a month. You put it all into a low-cost index fund. At a 7% average annual return, which is roughly the historical average after inflation for the S&P 500, you know what that gives you after 10 years? About $70,000. That's real money. That's not nothing. But it's also not life-changing. Now here's what changes that number entirely. What if, instead of just investing $405 a month, you also figured out how to earn $800 more per month? Maybe through a raise you finally negotiated. Maybe through a side skill you monetized. Maybe through a job change that paid you what you were actually worth. And then you invested that too? Same 7% return. you're now looking at something closer to $210,000. That's 3 times the outcome. Not because you found a better investment, not because the market was kinder to you, but because you changed the input. This is the first real principle of early wealth building, and it's embarrassingly simple. The size of what you invest matters more than the rate of return when your time horizon is short. Compound interest is exponential, but it's exponential over long periods. In the early years, years 1 through 10, you're still mostly in the flat part of that hockey stick. The curve hasn't kicked in yet. During this phase, the single most powerful lever you have is not time and it's not return rate. It's the amount you're able to invest. Which means the question isn't, how do I find the best investment? The question is, how do I dramatically increase how much money I have available to invest? And that is a completely different question. That's a career question, a negotiation question, a skills question, a business question, a spending psychology question. Let's break this down into the 3 things that actually move the needle early on. The first is income trajectory, not income level. There's a huge difference between making $60,000 a year and being on a trajectory toward 90,000 inches 3 years versus making 60,000 and plateauing there for a decade. Most people, when they think about their finances, think about their current income as a fixed number. They budget around it, they plan around it, they accept it as basically permanent. But the people who build wealth early treat income as a variable, as something to be engineered. And the psychology here is fascinating. Studies on salary negotiation consistently show that most people, especially younger workers, dramatically underestimate how willing employers are to pay more for someone who can clearly articulate their value. One study found that failing to negotiate your first salary costs the average worker over $500,000 over a career when you account for compounding raises. And yet most people don't negotiate because it feels uncomfortable, because they worry the employer will think less of them, because they were never taught that it's normal and expected. That discomfort is costing people more than almost any investment mistake ever could. Income trajectory is the engine. Everything else, saving, investing, compound interest, is what happens to the fuel after you've burned it. If the engine is weak, it doesn't matter how efficient the fuel system is. The second is savings rate, not savings amount. This one sounds like the same thing, but it isn't. Here's an example. Imagine 2 people, both earning $60,000 a year. Person A saves $500 a month. Person B saves $1,200 a month. Same income, very different outcomes. Now the obvious question is, why is person B saving more? And the answer is almost never that they're more disciplined or more naturally frugal. It's almost always that they made different decisions about what to spend money on, especially when their income was lower. They didn't let their lifestyle inflate every time their income grew. They lived on less and banked the difference. There's a psychological concept called lifestyle creep. It's the nearly automatic tendency for spending to rise in proportion to income. You get a raise, so you move to a nicer apartment. You get promoted, so now you drive a nicer car. You're earning more, so eating out 5 nights a week feels reasonable. None of these are bad decisions individually. Together, they're the reason most people feel broke at every income level. The antidote to lifestyle creep isn't deprivation, it's intentionality. It's asking, before every upgrade, whether this purchase is moving you toward the life you actually want, or whether you're just doing it because that's what people at your income level are supposed to do. Because here's the thing. The gap between what you earn and what you spend, that gap is your wealth building engine. Compound interest can only work on what you actually invest. And most people are so busy filling that gap with consumption that compound interest never gets enough fuel to do anything meaningful. The third is something most finance channels never talk about, and it might be the most important. It's called human capital. Human capital is the total value of your skills, knowledge, network, and earning potential as a person. And in your 20s and early 30s, your human capital is almost certainly your largest financial asset by a lot. Think about it this way. A 5-year-old with a marketable skill set, a growing network, and strong career momentum might have a human capital value of $1 million or more. Meaning, over the next several decades, The decisions they make about their career and skills will generate far more wealth than any investment portfolio they build in their 20 seconds. And yet most financial content ignores this completely. The entire personal finance genre is obsessed with what to do with money after you have it, but remarkably uninterested in how to get dramatically more of it in the first place. Investing in your human capital, taking the course, building the skill, going to the networking event, finding the mentor, making the career pivot often has a far higher return on investment than anything you'll put in the stock market in the early years. A $2,000 course that helps you land a $15,000 raise has a 750% return in year one alone. No index fund is going to do that for you. Here's where it gets really interesting. And this is the part that I think changes how people understand wealth psychology entirely. There's a reason we fixate on compound interest as the solution. And it's not because we're bad at math. It's because compound interest is passive. It asks nothing of us. It doesn't require us to be uncomfortable, to negotiate, to be rejected, to take risks, to change careers, to have awkward conversations about money or value or worth. Compound interest is the financial equivalent of hoping things get better if you just wait long enough. And psychologically, we are wired to prefer passive solutions over active ones, especially when the passive solution comes with a chart that makes it look inevitable. The brain genuinely cannot tell the difference between the feeling of having a plan and actually having one. The compound interest chart creates the feeling of a plan without requiring any of the actions that would actually produce results. This is what psychologists call a psychological substitute. You get the emotional satisfaction of doing something about your finances. You opened the account, you started the automatic transfer, you watched the number go up by $12 without doing the harder things that would actually move the needle. And the finance industry, consciously or not, has built an entire ecosystem around this psychology because passive investing is scalable. It's easy to sell. It requires no expertise and almost no active involvement from the investor. So the message that gets repeated over and over is start early, be patient, compound interest will do the work. And it will, eventually, if you also do all the other stuff. But the other stuff is harder to put in a chart. Now here's the deeper insight. And this is really the core idea I want you to take away from this. Compound interest is not the cause of wealth. It's the symptom. The people who benefit most spectacularly from compound interest are the people who built large investment balances early, not by waiting, but by aggressively growing their income, keeping their spending low, and investing the difference while their friends were busy upgrading their lifestyle. The compound interest is what happens to the wealth after they built it through behavior. The math rewards the behavior. But if you're hoping the math will replace the behavior, you're going to be waiting a long time for a miracle. Let me give you a metaphor that I think captures this perfectly. Compound interest is like wind. If you're sailing, wind is incredibly powerful. It can take you enormous distances with very little effort. But wind doesn't build the boat. Wind doesn't teach you to sail. Wind doesn't decide the destination. If you're sitting on the shore, waiting for the wind to do something useful, you can wait your whole life. The people who get rich from compound interest aren't the people who understood how wind works. They're the people who built the boat, learned to sail it, and then let the wind do what it does. The wind is the reward for everything that came before it. So what does this mean for how you actually think about money in your 20s and 30s? It means the mental model needs to completely shift. Most people in their 20s are asking, what should I invest in? The better question, the one that will actually move the needle, is what can I do to dramatically increase how much money I have available to invest over the next 5 years? Those are radically different questions. The first one is answered by choosing between an S&P 500 index fund and a total market fund. The second one might be answered by switching industries, learning a high-income skill, starting a small side business, moving to a city with higher salaries, or finally having the conversation with your manager that you've been putting off for 2 years. One question has about a 0.3% impact on your outcome. The other one could change everything. Okay, so let's get practical, because I know what some of you are thinking. This sounds great in theory, but what am I actually supposed to do with this? Here's a framework I want you to consider. Instead of organizing your financial life around a savings target, save X% of your income, organize it around 3 active priorities that each deserve real attention. First priority, engineer your income upward, aggressively. This is not about grinding yourself into the ground. It's about being strategic and proactive rather than passive. Start by asking yourself, when did I last negotiate my salary? If the answer is never or more than 2 years ago, you are almost certainly being underpaid. Markets change. Your skills have grown. Employers expect negotiation. Look at people 3 to 5 years ahead of you in your field or a field adjacent to yours. What are they earning? What skills do they have that you don't? Those skills are not the mountain. They're the staircase. Each one you add is a step upward. And here's something important. You don't need to double your income overnight. What you need is a trajectory. If you can grow your income by 10 to 15% per year for 5 years, you'll be in a completely different financial position than the person who stayed comfortable. Not because of what you earned, because of what you were able to invest. Second priority, protect the gap between income and lifestyle. Every time your income grows, your first instinct will be to upgrade something: the apartment, the car, the wardrobe, the restaurants. This is normal. This is human. And it's also the most reliable way to stay in the same financial position, regardless of how much more you earn. I'm not saying never spend money on things you enjoy. I'm saying be deliberate about it. Before any lifestyle upgrade, ask yourself 2 questions. First, if I were still earning what I made 2 years ago, would this feel justified? Second, is this upgrade moving me toward a life I've actually designed, or am I just doing what's expected of someone at my income level? The people who build wealth early are not people who sacrifice every pleasure. They're people who are very intentional about which pleasures they choose and who don't automatically upgrade everything every time they earn more. Third priority, make investing automatic before you can make excuses. This is where compound interest comes back in. Once you've protected your gap, the difference between what you earn and what you spend, automate the investment of that gap immediately. The day your paycheck lands, the investment should already be happening. Not a week later, after you've seen how much is left. On the day, automatically. Because here is the uncomfortable truth about human psychology and money. We are terrible at saving what's left over. We always think we'll have more left over than we actually do. We always find things to spend it on. The way you defeat this tendency isn't through willpower. It's through automation. Make the decision once, remove it from your daily awareness, and let the process run. And when the market drops, and it will drop, don't look at it as disaster. Look at it as a sale. Because when the market drops 20%, that means every dollar you invest is buying 25% more than it was a few months ago. The people who get scared and pull out are the ones who miss the recovery. The people who stay in and keep investing through the downturn are the ones who the hockey stick actually works for. Now, here's something I want to add that doesn't get said enough in finance content. The psychological cost of not starting is real. Every year you delay building the habits and systems around money makes it marginally harder to start. Not because of compound interest math, because of behavioral inertia. The brain is very good at normalizing the current state of affairs, whatever that state is. If your current state is spending everything you earn, your brain will normalize that. Starting feels harder with every passing year, not because it's objectively harder, but because the habit grooves get deeper. This is actually the one place where starting early truly matters, not for the compound interest math, but for the behavioral math. Start the habits now, even if the amounts are small. The amount grows with your income. The habits have to be built regardless, and they're easier to build when the stakes are lower. Here's what I want you to take away from this. Compound interest is real. It's powerful. It will, over a long enough timeline, do genuinely remarkable things for your financial life. None of that is wrong. But if you're 24 or 27 or 31, and you're sitting there waiting for compound interest to save you while staying in a job that underpays you, while letting your lifestyle eat every raise you get, while telling yourself that patience is the whole strategy, then compound interest isn't your plan, it's your excuse. The people who actually benefit from the hockey stick chart, the ones whose wealth eventually does take off, almost never got there by waiting. They got there by spending their early years aggressively building income, ruthlessly protecting the gap between income and spending, and automating their investing so that compound interest had something real to work with. They didn't wait for the wind. They built the boat. And then the wind did what wind does. So here's the question I want to leave you with. Not, am I investing? That's too easy. The real question is, am I doing the harder things? Am I growing my income? Am I protecting my gap? Am I investing in my own skills and value the same way I invest in the stock market? Because the market will do what the market does. The variable you actually control is you. And the earlier you figure that out, the more of the hockey stick you get to ride.